Hey seniors, glad you are here! In this video, I am going to show you why the balance in your 401k is not the amount your family will actually receive, and 5 decisions the IRS is giving you until December 31st, 2026 to make before the planning window closes permanently. Diane Kowalski stared at her $387,000 401k statement and realized for the first time that the money was not fully hers. She was 64 years old, a retired high school principal in Boise, Idaho, and what she had just discovered was that at age 73, the federal government would begin forcing that money out of the account whether she needed it or not. Every dollar that came out would be taxed as ordinary income, stacked on top of her Social Security, stacked on top of any other income she had. And the higher that stacked income climbed, the more Medicare would charge her. She called her nephew, a CPA in Denver, and said 7 words she had never said in her life. "I think I made a very expensive mistake." Nobody told Diane when she opened that account at 29. Nobody sent a letter at 55 explaining what the balance would cost her at 73. The financial institution that collected fees on that account for 35 years never sat her down and showed her the lifetime tax calculation. The system is not designed to show you that number. It is designed to collect the fee and let the tax bill arrive on someone else's schedule. This is not just Diane's situation. If you have a 401k, a traditional IRA, or any pre-tax retirement account, this video is for you. 5 things to check before December 31st, 2026. Your 2026 contribution window, your 2026 catch-up window, and your 2026 Roth planning window all close when the calendar year closes. Once a tax year ends, you cannot go back and redo it. Smash the like button right now. Not at the end, right now. Because every tap puts this in front of one more retirement saver who has been watching a 401k balance grow for 30 years and has never been shown the tax calculation attached to it. One tap. Do it. Subscribe and flip the notification bell. Section 3 is the provision most workers aged 60 to 63 miss entirely, and it disappears permanently once they age out of that window. Section 4 changes what your children actually keep when they inherit your retirement account, and the answer is different depending on one decision you make now. But both of those sections require understanding Section 1 first, because the forced withdrawal rule is what creates the problem that Sections 2, 3, and 4 exist to solve. Watch in order. This is not tax advice. This is the calculation your financial institution has never run for you. Section 1. The rule that turns your 401k into a tax time bomb. Most people with a traditional 401k believe the same thing. They contributed every year, they got the employer match, they watch the balance grow, and they assume that in retirement, they will simply pull money out when they need it and pay a modest tax as they go. Here is what they are missing. Under Secure 2.0 rules, every owner of a traditional 401k or traditional IRA must begin taking required minimum distributions RMDs at age 73. The IRS calculates how much must come out each year based on the account balance and the owner's life expectancy. The account holder does not choose the minimum, does not choose the timing, does not get to say no. If an RMD is missed or taken short, the penalty is 25% of the amount that should have been withdrawn. Go back to Diane, she has $387,000 today. If she makes no changes and allows the account to grow at a modest rate, that balance could reach $500,000 to $600,000 by the time she turns 73. At that point, the IRS may require her to withdraw $19,000 to $23,000 per year every year, whether she needs the money or not. That withdrawal is taxable income. It stacks on top of her Social Security. It stacks on top of any pension income. It stacks on top of interest, dividends, and capital gains. And when stacked income rises past certain thresholds, Medicare takes notice too. The 2026 standard Medicare Part B premium is $202.90 per month. When modified adjusted gross income exceeds $109,000 for a single filer or $218,000 for a married couple filing jointly, Medicare begins adding IRMAA surcharges on top of that standard premium. The RMD forces income up. The higher income can push Medicare premiums higher. The retiree gets hit twice on the same money, once through income tax and again through higher Medicare costs. The system was built this way. Nobody explains it when you open your first account at 29. There is no letter in the mail at 55 showing the RMD projection at 73. Section 2. The Roth conversion window and why 2026 matters. A Roth conversion takes money from a traditional 401k or traditional IRA, money that has never been taxed, and moves it into a Roth account. Tax is paid on the amount converted today. In exchange, that money grows tax-free. Qualified Roth withdrawals in retirement can be federal income tax-free, and Roth IRAs have no required minimum distributions for the original owner during their lifetime. That one detail alone can change an entire retirement. But a Roth conversion done carelessly creates its own problems. Convert too much in 1 year and the taxable income can push you into a higher bracket, increase the taxable portion of Social Security, and trigger exactly the IRMAA surcharges the conversion was meant to prevent. The real question is not whether to convert. It is how much can be converted in the right year at the lowest possible tax cost. 2026 matters specifically because the One Big Beautiful Bill created an additional $6,000 deduction for taxpayers aged 65 and older, $12,000 for a qualifying married couple available for tax. Years 2025 through 2028. This deduction stacks on top of the standard deduction and the existing age-based additional deduction. It phases out for single filers above $75,000 in modified adjusted gross income and for joint filers above $150,000. For a retiree who has reached 65 and whose income is currently low, delaying Social Security, living from savings, not yet taking RMDs, the combined deduction room available in 2026 may be larger than in almost any other year of retirement. Converting a carefully calculated amount from a traditional account to a Roth during a low-income year can mean paying tax on the conversion at 10 or 12% now rather than 22 or 24%. When RMDs force the same money out at 73 alongside Social Security and pension income. Meet Robert and Carol. Both are 62 years old. Both have approximately $400,000 in a traditional 401k. Both receive a pension of around $19,000 per year. Both plan to claim Social Security at 67. Robert heard about Roth conversions 3 years ago. He meant to look into it. He never did. He is waiting. It feels comfortable. Carol sat down with a CPA in 2026. They reviewed her pension, her deductions, her tax bracket, her Social Security timing, and her future RMD projection. They identified a $28,000 partial Roth conversion that fit her situation. She paid tax on that conversion at a controlled rate, not painless, but planned. If Robert's account grows to $700,000 by age 73, his first RMD could be $27,000. That stacks on top of his pension. Later, it stacks on top of Social Security. It may push the taxable portion of his Social Security higher. It may cross the IRMAA threshold and increase his Medicare premiums. And he will face that calculation every single year with significantly less flexibility than he has today. Carol's future looks different. By converting partial amounts during lower income years, she reduces the size of her future traditional balance. Smaller balance means smaller RMDs. Smaller RMDs means less stacked income. Less stacked income means a lower chance of crossing Medicare thresholds. The difference over 15 or 20 years can be $40,000 to $70,000 or more, depending on account size and tax rates. That is not a small adjustment. That is years of Medicare premiums. That is the inheritance your family keeps instead of the tax bill the system builds quietly while nobody shows you the calculation. Send this video right now to one person you know who has a traditional 401k and has never had a specific conversation about what RMDs will cost them at 73, not after you finish, right now. Because every year without a Roth conversion strategy is another year of building a larger forced income event at the worst possible tax moment. Section 3. The super catch-up most workers 60 to 63 never use. If you are aged 60, 61, 62, or 63 inches 2026, you may be able to contribute more to your 401k than almost any other worker in the country, and most people in this window have never been told it exists. The regular 401k contribution limit for 2026 is $24,500. Workers aged 50 and older can add an $8,000 catch-up contribution for a total of $32,500. But workers specifically aged 60, 61, 62, or 63 qualify for a higher catch-up amount of $11,250 under Secure 2.0 rather than the standard $8,000. That brings the total potential employee contribution for this age group to $35,750 in 2026. The difference between the standard catch-up and the super catch-up is $3,250 per year. For someone in the 22% federal bracket, that is approximately $715 in tax savings on the additional contribution alone. The window is narrow. Once you turn 64, you lose access to the super catch-up permanently. There is no retroactive application. The year you missed is gone. If you are currently between 60 and 63, call your HR department or plan administrator this week and ask 2 specific questions. First, am I eligible for the higher Secure 2.0 catch-up contribution in 2026? Second, does this plan allow Roth catch-up contributions if required? Beginning in 2026, high earners whose prior year wages exceeded $150,000 from that employer must make catch-up contributions on a Roth basis. If your plan does not properly support Roth catch-up contributions, you need to know that before the payroll year closes. One call, under 30 minutes, a contribution opportunity that cannot be recreated once the year ends. Section 4. What your children actually inherit. Most people think a Roth conversion is about their own retirement. It is also about what their children receive. Under the Secure Act, most non-spouse beneficiaries who inherit a traditional 401k or traditional IRA must empty the account within 10 years. Every dollar they withdraw from a traditional inherited account is taxable to them as ordinary income in the year of withdrawal. Consider a 5-2 year. Old engineer earning $148,000 per year who inherits a $400,000 traditional IRA from a parent. Under the 10-year rule, she may need to pull $40,000 or more per year from the inherited account. That $40,000 stacks on top of her salary. In a high-earning year, the combined marginal rate on that inherited income can approach 30 to 35%. She inherited money, she also inherited the tax bill. Her parents built the balance. The IRS collects on delivery. A qualified Roth account passes differently. The 10-year distribution rule may still apply to non-spouse beneficiaries, but qualified Roth distributions can be federal income tax-free. The beneficiary distributes the account on the required schedule. The tax character is different. They keep more. The planning decision made by the parent during a low-income year in their early 60s determines what the child pays in taxes at 52. The question is, not only will my tax rate be lower today or tomorrow, it is also will my children inherit an asset or a tax bill. The financial industry that managed the account for 30 years never ran that calculation for the account holder because the fee structure does not change based on what the beneficiary pays in taxes a decade after the account holder dies. Here is what connects everything. A traditional 401k is a future income machine. When that income is forced out through RMDs at 73, it stacks on top of Social Security, pension, and Medicare threshold. The Roth conversion window currently available in 2026, with the additional $6,000 senior deduction for those 65 and older, is a specific planning opportunity to move money from the forced income column, the tax-free column, at a controlled rate. The super catch-up for ages 60 to 63 at $35,750 total is a narrow window that closes when you age out of it. And the Roth decision affects not just your retirement, but the tax bill your children inherit. 5 actions, each takes under 30 minutes. Pull your most recent 401k or IRA statement. Write down the total pre-tax balance. That is the number the tax calculation starts from. Go to irs.gov and search Publication 590B. Read the section on required minimum distributions. Understand the basics before someone else explains them too late. If you are between 60 and 63 inches 2026, call HR today and ask whether you are eligible for the $35,750 total contribution limit and whether the plan supports Roth catch-up contributions. Review the 2026 IRMAA income thresholds. Single filers above $109,000 and joint filers above $218,000 face surcharges above the $202.90 standard Part B premium. Know where your projected income sits before a Roth conversion pushes you over the line. Call a fee-only CPA who specializes in retirement tax planning. Ask specifically, can you help me calculate a partial Roth conversion for 2026 that accounts for my tax bracket, future RMDs, Social Security taxation, IRMAA, thresholds, and the current senior deduction rules? Bring your account, balance your pension, estimate your Social Security projection, and last year's tax return. The tax code does not send a warning when the window closes. December 31st closes the 2026 contribution year, the 2026 catch-up window, and the 2026 Roth planning year simultaneously. The planning flexibility available today is not available in the same way next year and is not available at all after the calendar closes. Smash the like button right now. Subscribe and flip the bell. Drop a comment telling me the number in this video that surprised you most. The RMD projection, the super catch-up, the inheritance tax calculation. I read every comment. You now know the calculation. You now know the window. The only thing left is to make the call before December 31st closes it.